People believe that there are two tax codes in the United States, one for the rich and one for the poor. I will argue that there's one for the informed and one for the uninformed. We want you to be informed. Join us on Consider This program today, and we'll break down what bracket bumping is really all about. Well, good morning and welcome back to Consider This program. I'm your host, Joe Clark.
And I'm CPA Ben Smith.
CPA Ben Smith. I've never put that. There you go. Hey, Ben is the president of Estep Doctor and Company, a CPA firm located and based, I should say, in Muncie, Indiana. Also has an office in Anderson, Indiana. We have been working with Ben for 3 or 4 years, and people and partners that he's got inside of his company. And we have a lot of mutual families that we take care of. And one of the concepts that I want to introduce to you today is what I call bracket bumping. We use it with a lot of the families that we take care of. I'm going to give you a scenario, and then Ben and I are going to kind of walk through it real quick. So we're going to pretend like we have a 65-year-old individual. You've got $500,000 in an IRA, $200,000 in a Roth IRA. Well done, by the way, for having $200,000 in the Roth IRA. Another $250,000 that's in cash sitting around. So real near $1 million in assets. 65 has plenty of income and to be able to maintain his standard of living, Ben. So what we know is his taxable income right now is about $70,000 a year. Now, based on what I just told you, $500,000 in the IRA, $250,000 in cash, $200,000 in the Roth, what would we recommend him do?
Well, we have a couple of options.
I should say.
Yeah.
They're married.
65.
Yeah.
So, if they're at 70, we're in that lower tax bracket. We want to try to get as close to that lowest tax bracket as we can. We can do some Roth conversions, right?
Mm-hmm.
We can take traditional IRA money, convert it to a Roth, pay the tax now, and then it goes in with his other Roth, and we have the opportunity to grow that tax-free.
So what you have to, and we call it bracket bumping, right? We recognize, and you do too if you've been watching this show for very long, that the best way to understand the U.S. tax code is a series of stair steps, right? And that first step, once you have taxable income, so you've taken away your standard or your itemized deductions, you have your taxable income on your return, and then that first block of money is going to be taxed at 10%, lowest in history, right? And then you're going to take a 20% jump up to 12%. Now, when I say a 20% jump, some people say, well, Joe, that's only 2. No, that's 20. That's 20. Let's do the math, right? And we go into that 12% bracket. As of 2021, that's where the bracket is. Once you go above that next step, which is effectively $106,000 when you consider your itemized or your standard deduction, it's a lot lower than that. But when you have the credit you get for the deduction, it takes you to about $106,000 at age 65, married, filing jointly. Next step would be 22%. Ben, the difference between 22 and 12.
It's not 10%.
It's not 10%. It is.
It's almost double.
It is almost a doubling. Yeah. And I will argue that the difference between a successful retirement and a failed retirement for many people is on that tax return. It really is optimizing how those taxes work. So when we get into this concept of bracket bumping, this is where we work with you and your team and are able to go in and say, okay, this is what the tax liability is going to look like. And we know that's why we send out the tax planning package. You get one from Ben or one from us that comes out right around the first week in October. And we're going to ask some very specific things like, has your income changed? Has your filing status changed? Was there anything that went on this year that we really didn't know about? A big gift or something of that nature. And then once we know that, we're going to begin to do those Roth conversions. So Ben in his office or Brett in our office will do the math. And we'll say, hey, we've got $30,000 that we can do something with. So we have 3 choices with the $30,000, right, Ben?
Yeah, certainly we can convert it, right?
Convert it to a Roth. That's always going to be the one. Remember, there is no age limit on a Roth conversion. Right. You don't have to have earned income on a Roth conversion. There is no AGI restriction on it. So the oldest Roth conversion I believe I've done is for a 92-year-old.
Right.
There is no age limit.
That's my favorite because you're going to pay the tax now, but you're going to get that tax-free growth in the Roth. You can take the money out, right? And just pay the tax and then put it in a brokerage account or other investment account.
Yeah. I just read an article the other day because that's what I get paid to do. It came from a CPA, CFP. So had both of our credentials together, one person, right? And the argument Very, very similar case, mind you. And the argument was that they should leave the tax-deferred money alone and live off of that $250,000 so that they're at a lower tax bracket.
The cash, live off the cash.
And live off of the cash.
Yeah, right. Absolutely. And, another thing that plays into this is Social Security, right? Deferring Social Security. So that's why you need to work with myself, Joe, figure out exactly where you're at, and then we could push the right button, so to speak, to make sure we get the optimal tax effect for not just now, but down the road.
So the key thing that we're trying to get at, though, with this bracket bumping is the article from the CPA and the CFP, in my opinion, based on the data that they put into the article, was entirely inaccurate. See, what you have to understand is that $500,000 that's inside of that IRA is going to get taxed. It's either going to get taxed by you when you pull it out, it's going to get taxed by your spouse when they pull it out, or it's going to get taxed by your children when they pull it out. The only way around that is to leave it to a charity, and then the charity is actually not taxed on the money that's in it. But then you're giving away all of the capital, right? Sure. So when you go in and you do the math, Ben, talk about required minimum distributions real quick and the age that changed.
Absolutely. So under the CARES Act a little over a year ago, we used to have at age 70 and a half, if you had an IRA, you were required to take out an RMD, required minimum distribution, based on the value of your account the prior year. The IRS has a table. I believe it's right around 6%, 6.4 the first year.
It depends. About 3.5 at 70 and a half.
It's 70 and a half.
Yeah.
Okay. So,
but people delay it as long as they can possibly delay it.
Right. Because case in point, I have a longtime client who has a significant IRA, and every year he has to pay tax on money that he doesn't need because he didn't have the proper planning before he came to me. To get that done, to accomplish what we want to try to do with the Roth IRA and some of these other options. So at 70 and a half, the old rule, you had to start taking that out. Now it's 72. So you have a little bit longer now. If you're in the 65 to 70 and a half to 72 range, we can do more planning now to, again, convert other options so that you don't have to pay tax on that RMD. When you get to 72, then we kick in with the charitable contribution, direct charitable contribution.
If you're doing charitable contributions, the QCDs, absolutely. But the one thing, the key thing here is you're going to pay taxes on the RMD. Not Ben can't get you around that. Right. I can't get you around that unless you're giving the money away to a charity and you're over 70 and a half. At 72, you are going to take money out of that IRA, and it is going to continue. If we do our job at the Financial Enhancement Group, it's going to continue to grow. And you're going to have a larger liability. You're going to turn 72, and I'm going to tell you, you have to take out about at that time 3.8 to 4% of the money, and it's that's assuming that you're married and everything's good in good order, and you're going to have all of this money on your tax return, and you're going to get moved up a bracket. Think about that stair step. The stair step is going to accelerate to a higher bracket, and there is not anything you can do about it. So what Ben and I are not proposing that you get away with not paying taxes on your RMD. What we're trying to do is to make sure you understand if this is done correctly, you're going to pay the least amount of taxes possible on the money that's inside of the IRA. You've got blocks of money. The person in this example did a great job. They've got tax diversification, right? And tax diversification, very simply, you got tax deferred, you got tax free, and you've got money that's already after tax. And what the author of this article supported what so many people say, and I think it's because they don't deal with people who actually have money, right? Academically, I understand the value of tax deferral. Academically, Ben, when I got into the industry 2 weeks before the crash in 87, they told me that people would retire at a lower tax bracket. And I believed them. And I'm here to tell you, it's just not what happens. It's not what you see either.
No, it's not the case. And that's why early on you have to educate, as you said, the tax code is for two people, those informed and those that are not informed. And we try to inform them so that we can maximize earnings, minimize taxes.
Right. Over the financial journey. It's not, remember, your tax return is a one-hit wonder, right? So when we look at this, and this is why this is so important, Ben's office and our CPA partners focus on great tax reporting, but they also know tax planning. And the problem is nobody picks up a phone to call about what happens before the end of the year. And so the relationship we have, the partnership that we have, we're able to help force that kind of conversation where it's on Joe's nickel and Ben's nickel, not your nickel, to be able to come in and say, okay, here's how this looks. We will provide that next steps complimentary meeting. It's 90 minutes. You bring in your stuff, we will sit down, and between a CPA and a CFP and other people that are on our teams, we will give you things that you need to consider today, things you're going to want to consider in the future, and if we choose to partner together, what FEG or Estep Doctor will do for you, and we'll put it into writing. It's called a Next Steps meeting. You simply go to yourlifeafterwork.com, click on it, get signed up. We're happy to sit down and have that conversation. We will go over your tax return, and we will talk about what Ben and I call the 5 critical elements. I actually trademarked the family focus process years ago. So we'll talk to you about your financial vision, and then we'll break it down into what we call your life after work, because, Ben, most people don't retire.
That's right.
I mean, it's they seem to have something else that they find to do one way or the other. The annual tax plan, which is where Ben and I and our teams become involved in helping you before the end of the year, so that when it's time for your CPA or Ben, whoever's doing your tax reporting, filing that 1040, you can tell the IRS the best possible story, right? Our job ends December 31st for the most part. Their job starts, right? But we work together, we collaborate in order to come up with the best plan and the best strategy for you, and that's really where we want to go. The third thing is the investment playbook. If you want to know about the market or get signed up for it, since 2007, we've put out a weekly video called The Market Carver. It's 5 to 9 minutes long, depending on the data for the week. It's a video that you get every Thursday morning at 11:04 Eastern Standard Time. Again, go to yourlifeafterwork.com. You can get signed up for that. It's a freebie. We're happy to share it, but it gives you insight into what's going on. The fourth and fifth thing then are the life happens. Ben, we see things that happen in people's lives all the time. They may only have it happen to them once.
Absolutely.
And we build checklists to help you prepare for that from a tax standpoint, from an investment standpoint, and truly from an emotional standpoint. Last but not least is the legacy plan. It's the estate planning stuff, and it's kind of got what got me into the industry, and it's one of the reasons we're able to work so well together is understanding how that works. Give us a call, 800-928-4001, or go to yourlifeafterwork.com.